The Australian government is approving new homes faster than it has in years. Permit timelines are shrinking. The political pressure to build is real. But the actual act of constructing a home, financing it, designing it, insuring it, surviving the contractor you hired, is getting harder in 2026, not easier. 6 separate forces are quietly stacking the deck against anyone trying to build their own place. And none of them get mentioned in the headline numbers about housing supply. Here is what makes this worth paying attention to. These are not fringe rules or obscure planning technicalities. They are active standards, live insurance markets, real council fee schedules, and documented insolvency statistics, all operating right now, simultaneously, on the same person trying to build a home. Zillow and Realtor.com will show you land prices. They will not show you what it costs to comply with every layer sitting underneath that listing. The forces covered here are national and state level, and they compound. That is the part nobody talks about. There is a version of this story where the government made Australian homes better, and that story is true. Since NCC 2022 was published, and states began phasing in the requirements across 2023 and 2024, every new home built in Australia must achieve a minimum 7-star NatHERS energy rating. It also must meet livable housing design provisions, wider doorways, accessible bathrooms, step-free entries. The intention is clear, the policy is defensible, and the long-term outcome for homeowners, lower running costs, better thermal comfort, more accessible spaces, is genuinely positive. But here is the part the brochure skips. Designing a home to 7 stars is not simply a matter of adding insulation after the fact. It reshapes the entire design process. Orientation, window placement, glazing specifications, shading systems, wall and roof construction details. Every one of those decisions now has to be modelled, documented and verified against the NatHERS simulation before a building permit gets issued. That modelling costs money. It requires a thermal performance assessor. It generates documentation that your draftsperson or building designer has to incorporate, revise and resubmit if the numbers come back short. For someone using a volume builder on a standard contract, this cost is largely absorbed into the company's process. The builder has already engineered their standard plans to comply. You pay a slightly higher base price and move on. But for an owner builder, or for someone commissioning a custom design on a non-standard block, a narrow lot, an unusual orientation, a steeply sloping site, this is an active design constraint that adds consultant fees, redesign cycles, and time. Time costs money when you're paying rent while waiting to build. The livable housing provisions add another layer. Compliant bathrooms need more floor area. Wider corridors affect the internal layout. If you are building a small home, a 90 square metre house, a compact granny flat, these provisions can consume a meaningful share of your total floor plan. The design gets harder to pencil in at a price point that made sense when you bought the land. What the 7-star standard does, structurally, is raise the floor on every build. The standard applies whether you're spending $250,000 or $2.5 million. That is good policy design. It is also, for the person at the lower end of the budget range, a real cost with no negotiating room. You do not get a partial exemption for building cheaply. You do not get a waiver for a remote location. The floor is the floor, and the floor just moved up. Ask anyone who has commissioned a custom design in the last 18 months and they will tell you the same thing. The first round of energy modelling almost never passes on the first attempt. Revisions happen, fees accumulate, timelines extend. The paperwork is getting faster. The actual build is getting harder. The cheapest path to owning a home, on paper, is building it yourself. You manage the project, you hire the trades, you cut out the builder's margin. In theory, you save tens of thousands of dollars. In practice, in 2026, the financing side of that equation is one of the most difficult parts of the entire self-build process. Mainstream lenders in Australia remain cautious about owner-builder loans. The caution is structural, not arbitrary. An owner-builder project carries more perceived risk than a standard construction loan, where a licensed builder is under contract. There is no builder's contract to underwrite. There is no guaranteed completion timeline. From a lender's perspective, the person borrowing the money is also the person managing the risk of the project blowing out. That combination makes risk assessors nervous, and that nervousness translates directly into loan conditions. In practice, what that means for the person building their own home is this: larger deposits, often 30 to 40% of the project cost rather than the 20% standard. Independent quantity surveyor assessments of the project budget, which cost money and take time. Contingency requirements built into the loan structure before the first slab is poured. Progress inspections at each drawdown stage, sometimes requiring a licensed supervisor to sign off, even when the owner is managing the build directly. Victoria adds a specific layer on top of the national lending picture. In Victoria, owner-builders who build above a certain value threshold, and who intend to sell within 6.5 years of finishing, carry domestic building insurance and warranty obligations. These are not optional. They are legal requirements that attach to the property and must be disclosed to any future buyer. The obligation exists because Victoria's consumer protection framework treats owner-built homes as a potential risk to future purchasers, not just to the person who built them. That is a reasonable policy. A buyer who purchases an owner-built home deserves to know what they are getting. But for the person who builds, it means navigating an insurance and compliance structure that a licensed project builder would handle automatically. It means understanding which obligations kick in at which value threshold. It means spending money on legal advice before you spend money on concrete. Residents who have worked through owner-builder loans in Victoria describe the process as front-loaded with complexity. The very moment you are trying to conserve cash, the system requires you to spend it on documentation, and here is the deeper structural irony. The person most likely to pursue an owner-builder path is the person for whom project builder prices are out of reach. They are turning to self-build precisely because it is cheaper. The compliance and financing barriers they encounter are not scaled to income. A $35,000 deposit requirement hits harder at $180,000 in savings than it does at $500,000. The system is calibrated for average cases. The person who needs the cheapest path is the one who finds the gate most difficult to open. Checkpoint. Something changed in the construction industry in 2024 that most people building homes never thought to track, until it hit their own project mid-pour. ASIC recorded it. The number is in the thousands. The next case is not about what it cost to start a build. It is about whether the company you hired survives long enough to finish it. I know this sounds like a problem for property developers, not for the person building a family home. It's not. Between 2024 and 2025, ASIC recorded a construction industry insolvency rate that reached historic levels in Australia. The construction sector led all industries for company failures. The firms going under were not only large developers, they were mid-sized residential builders, small commercial contractors, and the kind of regional construction companies that build a few dozen homes a year. When a builder goes into liquidation mid-project, the consequences for the client are severe and immediate. The site gets locked. Materials on site may be subject to creditor claims. Subcontractors who were owed money stop showing up, or show up to remove equipment. The building permit may require resubmission under a new builder. Every week of delay is a week of ongoing land loan repayments, rent on your current accommodation, and the slow deterioration of exposed work that was never finished or weatherproofed. The process of recovering through insurance, which is where domestic building warranty cover theoretically kicks in, is not quick. Claims take months. Disputes about what the insurance policy covers versus what it excludes are common. In the meantime, the frame of your half-built house sits open to the weather, and your budget is bleeding out in holding costs you never factored into the original spreadsheet. Choosing a builder in this environment is genuinely a financial risk management decision, not just a quality comparison exercise. The questions that matter in 2026 are not only about the builder's previous work or their quoted price. They are, what is the company's current financial position? Are they carrying the debt load of previous fixed-price contracts signed when materials cost 20% less? Do they have enough cash flow to pay their subcontractors through your build, or will your project be the one that finally tips them over? These are not questions that an average owner-builder or first-time self-builder knows to ask. They are questions that a commercial developer with a legal team and an accountant asks routinely. The information asymmetry is real. You can ask for a reference from a previous client. You cannot easily inspect a private company's balance sheet before signing a building contract. The risk is invisible until it isn't. What the insolvency wave has done to the broader market is harden everyone involved. Builders who are still trading are being more selective about which fixed-price contracts they take. Subcontractors who are burned by builder collapses are requiring larger upfront payments or shorter payment terms. The friction that used to exist mainly at the planning and approval stage has moved into the construction phase itself. Getting a permit faster means nothing if the industry executing the build is under financial strain. Building insurance feels like the safety net under the tightrope. The policy exists, the regulator requires it, and theoretically, if something goes catastrophically wrong, you are covered. In New South Wales in 2026, that safety net is becoming harder to reach and more expensive to stand on. Domestic building insurance, also called home warranty insurance in some states, is mandatory in New South Wales for residential building work above a certain cost threshold. Licensed builders are required to hold it before they can take a deposit from a homeowner. It protects the owner if the builder dies, disappears, or becomes insolvent before finishing the work. The policy is not optional. It is a legal precondition for the contract. But the insurance market that provides this cover has been contracting. After the wave of builder insolvencies recorded through 2024 and 2025, insurers recalibrated their risk models. Premiums went up. Underwriting criteria tightened. Some insurers exited segments of the market entirely, reducing the competitive pressure that had previously kept pricing in check. For builders still operating, the cost of obtaining domestic building insurance increased. That cost moves directly into the builder's overhead, and from there it moves into your quote. For an owner-builder in New South Wales, the insurance picture is even more specific. Owner-builders who intend to sell within 7.5 years of completing the build must provide an owner-builder defect inspection report. The interaction between that requirement and the current insurance market means navigating a system that was designed for a more stable industry environment and is now operating under significantly more pressure. There is also the climate dimension. Insurers pricing domestic building insurance in New South Wales are not only looking at builder insolvency risk, they are looking at flood mapping, bushfire-prone land designations, and the increasing frequency of extreme weather events affecting completed homes. The risk pool for new residential construction insurance has expanded. The premium pool available to spread that risk has not grown proportionally. The result is upward pressure on costs that has nothing to do with the quality of your build or the competence of your builder. Ask anyone who has recently obtained a construction insurance quote in regional New South Wales, and they will tell you the number came back higher than they expected. Sometimes significantly higher. Insurance that was meant to be a background compliance cost has become a line item with real weight in the project budget. The safety net is still there. It is just higher off the ground than it used to be. Checkpoint B. The next force on this list does not appear in the permit application. It does not show up in the build quote. It sits in a geographic overlay that most buyers never read before they purchase a block. And on some types of land, it can add tens of thousands of dollars to a build before a single wall goes up. The rating that triggers it is a 3-letter code. Here is a pattern that plays out across rural and fringe New South Wales with enough regularity that it deserves to be named. Someone finds a block of land. It is affordable. It has space. It is outside the urban fringe, away from the density and the prices, with trees and a view and the kind of quiet that is genuinely hard to find. They run their due diligence on zoning and services and setbacks. They buy the land. Then the BAL assessment comes back. Bushfire Attack Level, BAL, is a rating system under Australian standard as 3959, which governs construction in bushfire-prone areas. The rating is calculated based on how much flammable vegetation is near the proposed building, the terrain, the fire danger index for the region, and the distance from that vegetation to the building footprint. The ratings run from BAL Low, which has no additional construction requirements, through BAL 12.5, BAL 19, BAL 29, BAL 40, and up to BAL FZ, the flame zone designation, which represents the most extreme fire risk. As of 2025 and 2026, more land across New South Wales is being mapped as bushfire prone. The mapping is not arbitrary. It reflects genuine risk informed by updated fire behaviour modelling and the documented experience of recent fire seasons. But the practical consequence for the self-builder is direct. If your block triggers a BAL 29, BAL 40 or flame zone rating, as 3959 requires your home to be built to specifications that a standard residential construction quote will not cover. What those specifications look like in practice. Ember-resistant roof and eave construction, which means specific materials and details that a standard roof does not include. Bushfire-resistant glazing on windows and doors, and bushfire-resistant glazing is not a standard product at a standard price. Specific external wall construction, bushfire-rated vents, a dedicated water supply for firefighting purposes, sized to a minimum standard. These are not optional upgrades you can phase in later. They are building permit conditions. You comply before the certificate of occupancy is issued, or you do not get the certificate. The cost addition from a moderate BAL rating, BAL 29, which is common on lightly vegetated fringe land, runs in the range of $15,000 to $30,000 on a standard residential build, depending on the size of the home and the specific construction details required. At BAL 40, that cost can reach significantly higher. At flame zone, some builders will not quote at all. The structural irony is direct, and it deserves to be said plainly. The cheaper the block of land, the higher the probability it sits in a bushfire-prone zone. The land is cheap in many cases, precisely because it has been sitting at the rural fringe where infrastructure is thin and fire risk is elevated. The affordability of the land and the cost of building on it are not independent variables, they are connected. The discount in the land price can disappear entirely once the BEL construction premium is added to the build cost. For anyone building in New South Wales right now, the BL assessment is not a technicality to address after the contract is signed. It is a due diligence item that belongs before the land purchase because it directly changes the financial viability of the entire project. The land is cheaper for a reason. Finding out that reason after settlement is an expensive way to learn it. None of the forces covered so far compares to this one for sheer immediacy and scale. Every other force plays out over the design phase, the lending process, the construction period. This one hits before a wall goes up, before a slab is poured, before a tradesperson sets foot on site. It is a charge payable to the council as a condition of the development approval, and in parts of Queensland in 2026, it has just gone up by more than 70% in a single move. Tablelands Regional Council, in Queensland's far north, updated its infrastructure charges schedule effective 1st September 2025. The numbers are specific and they are documented. A one-bedroom dwelling. Infrastructure charge moved from a $15,000 to a $26,993, a 74.6% increase. A dwelling with more than 3 bedrooms, from a $22,500 to a $36,607, a 63% increase. You might think those figures are a misprint. They are not. These are the published council schedule figures. I want to be precise about what infrastructure charges are because the council's own framing matters here. These are not rates. They are not taxes, or at least that is the position the council takes. They are charges levied to fund the infrastructure, roads, water, sewerage, parks, that a new dwelling requires the council to provide or extend. The logic is that growth should fund itself, not be subsidised by existing ratepayers. That is a coherent policy position. For the person writing the cheque, the distinction between a charge and a tax is not particularly meaningful. A $26,393 is owed before the build starts. It is a fixed cost that sits on top of the land purchase, the design fees, the energy assessment, the soil tests, the building permit fees, the connection fees for power and water, and everything else that accumulates before construction begins. It is not scalable to the cost of the project. A person building a modest one-bedroom home and a person building a large custom home with the same number of bedrooms owe the same infrastructure charge. What makes the Queensland situation significant beyond the Tablelands example is that infrastructure charges, called infrastructure levies or contributions in other states, are a feature of council development approval across Australia, not a quirk of one region. The Tablelands numbers are documented and precise, which is why they are used here. But the mechanism, upfront charges payable before construction as a condition of approval, is a standard tool across Queensland, New South Wales, Victoria and beyond. The Tablelands increase shows what happens when a council recalibrates those charges to reflect actual infrastructure costs after a period of underpricing. For the self-builder doing a project budget, the lesson is structural. Infrastructure charges are not a line item that gets quoted by your builder. They do not appear in the construction contract. They appear in the development approval conditions, often as a separate schedule that you have to actively look for. It is entirely possible to plan a project budget in detail, land, design, construction, finishes, and not account for this charge at all until the development approval lands and the conditions are listed. At Tablelands Regional Council's current rates, a family building a 4-bedroom home is looking at a $36,670 payable to the council before a single subcontractor is booked. That is not a deposit, it is not refundable, and it does not reduce any other fee. It is the price of entry into the system, and from 1st September 2025, That price went up by 63% in a single schedule update. Locals who have been tracking land development in the Tablelands region describe the charge increase as a shock, not because infrastructure charges were unexpected, but because the size of the increase in one move compressed multiple years of cost adjustment into a single document. A project that was financially marginal before September 2025 may no longer pencil out after it. The land has not gotten more expensive, the approval just did. The full picture, when you lay all 6 forces alongside each other, is not one of malicious obstruction. Each rule, each charge, each insurance requirement, each energy standard has a rationale. Better homes, protected consumers, funded infrastructure, real fire risk accounted for. The problem is not that any single one of these forces is unreasonable. The problem is that they all apply at once to the same person, on the same project, in the same year. One set of approvals getting faster, and 6 separate forces each pulling in the opposite direction. The speed of the process and the difficulty of execution are moving independently of each other, and right now they are moving apart. The question is not whether these forces are justified. It is whether the person trying to build a home can absorb all of them simultaneously, without the project collapsing under its own compliance weight. Which of these 6 forces would hit your own project hardest? Write it below, especially if you're mid-build or planning one. And if this kind of structural breakdown helps you make better decisions before you commit, subscribe.